Good afternoon. This is Josh here at Chaikin Analytics, and I'd like to welcome you to 5 Simple Steps to Find Winning Stocks in 2019. Our presenter today is Sandy Chaikin, co-founder of Chaikin Analytics. As a reminder, this webinar is being recorded and a copy will be sent to all registrants tomorrow. Be sure to submit your questions through the webinar Zoom Q&A window, which you can access in the upper corner of your screen. I'll be available to respond to your questions throughout the webinar. Sandy Chaikin is co-founder of Chaikin Analytics, a groundbreaking stock research and analysis platform. With no prior experience, Sandy started investing in 2012 with Chaikin Analytics and built a killer portfolio that continues to outperform the S&P 500 and most money managers. Sandy is living proof that you don't have to be a financial expert to pick winning stocks. Thousands of investors attend her industry events and weekly webinars on fearless investing by following the Chaikin method. NASDAQ.com, Daily Worth, and Elevate all feature Sandy's investing articles and analysis. To get us started, here's Sandy Chaikin.
Hey, Josh, thanks so much, and thank you all for attending today's presentation. I see that many of you are from the Jim Cramer audience. I think over half of you actually registered came from one of Mark and Jim Cramer's joint presentations, which is great. So during those presentations, if you may recall, Jim and Mark recommended a lot of stocks and talked about a lot of stocks, but what they didn't talk about was how they found them. So what today is all about is to take you to that next level of being able to find these stocks yourself. And I'm going to show you how. So let's get started here. Volatility. Yeah, well, there's a lot of volatility in the last quarter or so, particularly December, which was a pretty wild month. I think we're getting kind of used to it by now, but I know volatility gives a lot of people the jitters and is stressful. What we at Chaikin believe, though, and particularly me believes, that volatility is an opportunity. This is when you can really make some nice profits on the upside or on the downside if you're trading options. So today is all about showing you how to take advantage of the volatility that's basically built into the market. Let's first take a look at the S&P 500 kind of in historical terms over the last year. As you can see, those straight green lines along the top are resistance lines. What you can see as in December was this huge dip that we experienced. It was a little bit similar to back last February. Remember last February, March, when we went through that dip as well, although it was much more pronounced. Many of the analysts, including our own analysts, Mark Chaikin and Dan Russo, were thinking that this might lead to another W bottom as it did back here in March. Although it's looking, they say, a little less likely now because the market has basically gone straight up since this low of Christmas Eve. We call that the Christmas Eve massacre, when stocks really tumbled and hit that real bottom going into bear market territory. To get into bear market territory, you have to go 20% or below, and it hit intraday that 20% below. But as you can see, since then, we've had a nice rise. It's come up 15% since that bottom, which is awesome. And they just closed out, we just closed out January with an overall 8% increase in the month, which is the strongest since, I think it was January of 1987, I think is what they were saying on the news this afternoon. So all that bodes well for opportunity. But in a market that's been going straight up like this, it's hard to find the opportunity of when to get in. It's kind of like a train, you know, running ahead. When do you jump on when it's already surging forward as much as it is? But there will be opportunities. There will be opportunities of dips, maybe 1 to 2 days. They're typically 3 days, but with this straight up market, it looks like 1 to 2 days may be more realistic. But today is all about making a shopping list of stocks that you want to buy when we get those dips, because we inevitably will. I mean, you can see here with this, you know, dipping down here. These are the dips. These are the pullbacks. when they dip down here, as they did last week or so, even on those slight movements, that can be an opportunity to buy a stock you've been watching. All right, so let's put these pullbacks in perspective. We've been in a decline of 10 to 20% over the last year. As I said in January, it hit that 20% mark, December 24th, however, briefly. Average number of declines since 1945 that have experienced that 10 to 20% drop have been 27, with the average decline of 13%. And last year was an off year. I think it was, 7% for the full year. The S&P was off. Now, these declines last an average of 4 months, which is really interesting because you take when the decline really started, which was October. You take October, November, December, January, and we're the last day of January 31st. Phew, we're done the 4 months of decline. So now we should be over here in the recovery months. We should be starting our first month of recovery if patterns repeat themselves. So these are obviously not predictions, but these are patterns. And these are really guidelines against which we can expect some following to happen. So let's look at the next months, February, March, April, as our recovery months, and hopefully we'll be coming out of this decline, as we saw in the fourth quarter of last year. This is pretty interesting because this has changed dramatically just in the last month. Fear and greed index. Okay, now we're at greed now, where you look at a month ago, so that would have been the end of December, we were at extreme fear. And I think for several months in that fourth quarter, we were in extreme fear. That was a lot of uncertainty in the market with all the China and North Korea and all the tweets and back and forth. This is on, this is off. The daily chaos was taking a toll on people's emotions, and they were fearful. We seem to have gotten used to it. My own analysis of that is that we've just gotten numb to it. And learn to accept that that's just the way it is in this presidency, and we can't let it get the best of us. Because this is what you can react to. This is the problem. These are what the news. This was just a snapshot of one day in December, and I mean, look at this. I mean, swings more than 500 points. It tumbles more than 500. Cutting out the gain for the year. I mean, this is what we got all of the latter part of 2018, excuse me. So you have to have a way to manage this, right? I mean, in your daily life, you have to find a way to manage stress. And if these daily swings are causing you stress, you need an approach and a methodology that's going to reduce that stress and allow you to still be a profitable investor or trader. And that's what I intend to show you in the next hour or so, are the 5 steps that I use as my proven methodology to conquer stress and become a profitable investor. Because what happens when we're stressed is that we run for the exits. Whenever the market drops, and that the research shows can cost you over 4% a year. That's a big number on a year by year basis. If you lost 4% every year because you ran for the exit out of fear, that's a loss you don't need to take. And here's another interesting piece of research, that the S&P has grown an average of almost 10% over the past 20 years. Yet individual investors have only averaged 2.5%. And of course, the reason is because we're human beings with emotions, and we buy on emotion, not fact. Can any of you relate to that? Buying on emotion, not fact. I mean, it's pretty hard to get that out of your head, but that's what we're going to be focused on this hour, because we want to be the type of investor that Warren Buffett feels is the best investor, where he says investors should be fearful when others are greedy, and greedy only when others are fearful. So in other words, be greedy, be buying stocks when they're at a low price, and they're at a low price when others are fearful and selling. And the reverse is true on the being fearful when others are greedy. When others are greedy after, say, a earnings report, a stock jumps up, say 10, 15%, like Boeing did yesterday, that's not the time to buy it. But that stock is jumping up because people are getting into it. Oh, the report was better, much better than analysts expected. Stock's going up. I better get into this. That's not the time to be buying, because all those people piling into that stock is what's raising the price, creating more demand for fewer shares raises the price. Think of it as an auction. You know, if a lot of people are bidding on a item, that price is going to be jacked up because a lot of people want it. That's not the time when you want a stock, is when others are wanting it because it's spiking on an earnings report like Boeing did yesterday. So that's just one example, and there's Boeing right there. But our solution, how to manage this stress and be a profitable investor, is to buy bullish rated stocks. Now, these are stocks that I'm either currently in, like Boeing, or have been in over the last year. And as you can see, the 1-year performance on these stocks far, far, far outpaces the S&P, same full year performance of -5%. I mean, these stocks are up 3 times that, say, on Boeing's, or, all the way up to WellCare, which was up 31% on a year-over-year basis. So these are the type of stocks you want to be in. These are all bullish rated stocks in our methodology. And I'm going to show you how I found these stocks and knew when to buy them, and in some cases when to sell them. All right, so my promise to you is that you're going to discover 5 simple steps to find winning stocks in 2019. Let me just briefly give you a 2-minute overview of how I got into trading stocks in the first place, or investing in stocks. When I worked in New York City for Elizabeth Arden and L'Oreal, and then outside Philadelphia for the Franklin Mint, I had a choice of investing in 401k plans, which included mutual funds. So I invested in those. I was able to select the mutual funds based on past performance. Fortunately, I picked the Fidelity Magellan Fund and the Legg Mason Value Trust, both of which did really well. So my 401k plan grew nicely, and as my career in management grew, and I was making more money, I was putting more money into the 401k, which the company was matching, and the fund grew and grew. So that was all well and good, but it got to the point where I didn't feel confident that I knew enough about investing to manage this type of money. So at the suggestion of a friend, who was a wealth manager, I engaged a wealth manager, and what he did was take the funds that I was in and sell them, and he put the money into stocks mutual funds of his own choice, about 8 or 10 mutual funds, which were okay for a while, but then, of course, along came 2008, and it became apparent very quickly that the account was going to be going down. And I kept calling him saying, this is all going to be going down. I mean, everything's going down. Everything's going down every day. Shouldn't we just sell this? And the reply was always, oh, no, no, it's better just to hold. They'll all come back. And because I lacked the confidence and experience, in my view, to override him, after all, he is the professional, I went along with it. But going into 2009, when I was down 50%, that really was a low point, and I said, I just can't do this anymore. I've got to just take the money out of his control and just put it in a savings account, or anything would be better than continuing to lose money. So it's a pretty devastating time because I had spent, gosh, 30 years building that retirement fund, and I'd given up some pretty nice vacations I could have taken, or dinners out with friends, etc., because I was squirreling the maximum amount of money I could into that 401k plan, and then to watch it basically be cut in half in a matter of months was a pretty devastating experience. And I'm afraid a number of you probably had the same experience, which you're welcome to chat into that Q&A box. If you can identify with this same difficult time in our lives. I'll give that a minute to kind of come through. So what Mark suggested, and we were just getting together at that time in 2009, he said, look, why don't you just take it out of the care of the wealth manager and open up a Vanguard self-managed account, put it in the S&P 500 until you figure out what to do. So that is exactly what I did. And since then, the account's been fine. It's up over 4 times where it was when I took it back, and all is good now. But the reason I'm here today talking to you is to ideally help you avoid that same type of a loss and a trauma by taking control of your investment future, by understanding how to invest and what to invest in, and by having a say at the table. And many of our members are wealth managers, which is terrific. And if you are working with a wealth manager, that's wonderful. But what you want to do is be knowledgeable enough to be able to have a discussion with him or her about why he or she is investing in what they're recommending, and have a say in it, so that you can basically kind of back test the ideas, looking at Chaikin Analytics for the stocks that the person is recommending, or if it's a mutual fund or an ETF, what are the highest holdings? What are the biggest holdings in that ETF? Let me look them up on my Chaikin Analytics and see what the power gauge rating says, because if the power gauge rating is pointing to bearish and negative, I don't think I want to invest in that. And we have a right to have a say in our own investment decisions. So this is what I want to encourage you to do now, because since I've taken control in 2009, it's been a whole lot better, and I feel much more confident, and not only confident in my investments, but being able to know that I can manage my own financial future has made me a more confident person in general. So without getting too much into a personal level, there's a lot of good reasons why you want to take control of your own investments going forward. And that's what we're about to do. So, okay, so why should you listen to me for the next hour? Well, since I started investing with Chaikin Analytics, is when we came out with the platform in 2012, I have been continually outperforming the S&P 500, and thus 4 out of 5 pros, because the research shows that 4 out of 5 pros underperform the SPY. You can see here, of the 8, 10, now more 12 or 15 stocks that I hold at any given time, I've had quite a number of winners. And this is what I want to show you how to do today. So even, in a year last year, which was a negative year, there were winners in there. Anthem, CNC, Centene, Crocs. These are the type of stocks that you want to be looking for. And why is that important? Well, you know what? We all make profits, want to make profits, want to make money, which is great for our retirement, but we also want to be able to enjoy some of those profits. So what Mark and I do is we take some of the profits that I make each year and we take vacations. And most recently, we were in Umbria, Italy, for the entire month of October, which is this beautiful green panoramic view here on the right from the little hill town of Spello, where we rented a place for the entire month of October. And this is a little typical street in Spello, and it's just the most charming, beautiful place you can imagine. But these holidays, vacations, call them what you will, are really thanks to the profits that I'm making. So think about how you want to spend some of that profit and enjoy it. Is it a new car you're looking for? Is it, college education you want to put that money towards? Down payment on a house? Whatever it is, have a goal in mind, and it'll make it a lot more fun and a lot more attainable, I believe, if you really have a purpose, a goal in mind when you're investing. So let's pause here for a minute. Josh is going to put up a poll question for you. And what I'd like to ask you is, what are the challenges you're facing today? Think of today, what gives you pause when you look at a stock and think, oh, gee, that looks like a good stock to buy, but I'm not going to buy it right now. Or, gee, maybe I should sell this stock, but no, I'm afraid to push that sell button right now. What is giving you pause? And you can check off any and all that apply. And I'll give you a few minutes here to do just that.
Give another 15 seconds, Sandy, and then we'll share the results.
Okay.
Let a few more people get in.
Great.
All right, give me a second, and we'll turn this around and share it with everybody.
Okay, interesting. I do ask this question on each presentation I give, and timing is always the biggest one, although here it's only 58%. Usually it's in the 70s or so percent. So that's a little bit less than normal. I see number 2 kind of tied for information overload and uncertainty in the market. Volatility, the Fed, that's everything that's going on today. And let's see, where are we for 4? It looks like lack of reliable tools. And then the rest kind of fall in underneath that. Lack of confidence. And lowest is lack of education and emotions. Okay, good. So timing is still number 1. Information overload. And what was the other one? Uncertainty in the market were number 2. And then 2 and 3, and then 4 is lack of reliable tools. Okay, great. Well, thank you all for participating. That's great. And I've already built in how to overcome these challenges into the presentation, because as I say, I ask this each time and I typically get similar replies. So the 5 steps that I'm going to be sharing with you today are starting with the tools you trust. That's addresses your lack of reliable tools. We're giving you reliable tools, so that overcomes that. Identifying a classic Chaikin bull. How do you identify those stocks that you want to buy? That's basically how do you what's important to focus in on a stock, and what noise should you factor out of this decision, and what's the important information you should be looking at. So this really overcomes information overload. Screening for stocks to buy on pullbacks. And again, part of how to identify a stock and knowing when to buy it. And of course, knowing when to buy and sell is timing, addressing your number 1 concern. How do I know when to buy and how do I know when to sell? I'm going to give you real live examples from my own experience of how I knew when to get in and how I knew when to get out. And then avoiding classic bears. And this is really avoiding, it's really risk management. in any investing, there is always going to be loss. That's just something I had a really hard time to get my head around when I started investing, but it's a reality. You cannot have winners all the time. The important thing is, though, how do you know when a stock is starting to break down so you can get out before it does? The platform I'm showing you today of the stock charts is from Chaikin Analytics. It's going to be screenshots of the desktop app. The app platform is also available on iPad, and those come bundled into the same subscription or membership when you join. The end of this, I'm hoping you're going to feel more like confident versus a fearful investor. Because without confidence, you're not going to be making good decisions. So in order to make sound investment decisions, you need to feel confident, not only about the tools that you have, but also about the methodology you're following. And that's all about today. So let's start with the tools you can trust. Reliable tools. For us, the foundation of that is the Chaikin Power Gauge rating. You can see it here. It's a very simple but not simplistic rating of a stock's potential to out or underperform the market over the next 3 to 6 months. This is the foundation of Chaikin Analytics. And Mark basically decided to create Chaikin Analytics during that 2008-09 meltdown, when he could see my distress and millions of other investors like me who had lost confidence in Wall Street and were taking literally billions of dollars out of traditional brokerage firms and putting them into self-managed accounts like I did with opening up an account at Vanguard. And he said, you know, now, Sandy, you've got your own account to manage and it's under your supervision, but you really don't know what you're doing. You don't have the education and you don't have the tools. So Mark came out of retirement in 2009. He had sold his company to a division of Reuters after a 40-some year career on Wall Street, where he had been creating tools for institutional investors so that they could make better decisions about how to invest their clients' money. So Mark said, you know, I'm going to take that same knowledge that I learned on Wall Street and build a set of tools that has the power, you know, of what I created for the pros, but is in a more simple more simple displays that are easier to understand. And that's exactly what we did. And that's, as you can see here, this is pretty easy to identify, right? This is a very bullish rating. So what he did was he took basically 4 basic components: financials, earnings, technicals, and experts. Those are the basic components under which he created a rating for each of those 4 that make up the overall rating. You can see here the example is on Starbucks. It's a very bullish rating, and you can see where those components kind of add up to it as well. And it basically takes the data you see on the right and boils it down to what you see on the left. So you take all that numbers, and if you knew what to do with those numbers and how to analyze, good for you, but I suspect most of us as individual investors don't have a clue. So this solves the information overload problem. This takes all that data on the right and boils it into a display that's very easy to understand, and it gives you an overall rating, but you can drill down on any of those 4 components, as I've done here for Starbucks. And you can also drill down on each of those factors. There's 20 in total that are rolled up into those 4 components. So you can get a power gauge rating on any of these 20 factors individually, rolled up, or any of these rolled up components, each taking one of the 5 of those factors, or the overall rating. So basically what I do is if I'm going to invest in a stock, I want that stock to be rated very bullish or bullish. And pretty much if it's not showing that rating, I'll move on and wait for one that does. So it really you really can get rid of a lot of the noise, a lot of the clutter, and there's so much talk on these financial news shows and these 24/7 programs. You can take the data that they're recommending and plug it into your Chaikin Analytics and get a power gauge rating on a stock and see for yourself if it's something that you really want to pursue more. What I like to do, as I say, is look at the overall rating. I like that rating to be very bullish or bullish, but also drill down on this component here, particularly now in this high volatility, and particularly now that we're in earnings season. The expert component is one that we really consider our secret sauce. This is data that's not that easily found elsewhere, but it's also can be highly predictive in determining where a stock is headed. Think of the power gauge rating as a GPS for stocks. It shows you where a stock is headed. So under the expert component, you can see there's these 5 ratings. And these all, I feel, have strong predictive value for determining where a stock is headed, particularly in earnings season, which we're in right now. Why count on models? Well, models beat humans. Models beat human forecasters because they reliably and consistently apply the same criteria time after time, as opposed to human beings who are swayed by emotions and opinions. So even though newscasters on the financial news networks, they're human beings. I mean, they have their own emotions and opinions and thus biases, and that is bound to factor into what they say when they're talking about or recommending a stock. The power gauge rating, just to give you a little bit of performance history on this, it's tested in back testing going back to 99, as well as the last 10 years in real life testing. And you can see here that if you had only invested in very bullish stocks, your portfolio would be up an average of 20% a year. And remember back when we started, I showed you the statistic that the SP 500 is up an average of 10% a year. So you could basically be doubling the SPY's performance if you invested only in bullish rated stocks. On the reverse side, if you were only in very bearish stocks, your account would likely be up an average of 1% a year, versus that, well, this is saying 9% average. So these are based on actual performance. And I mean, for me, using the power gauge rating, I find that it's reliable 70 to 80% of the time. It points me in the right direction. There's no indicator or tool that's going to be 100% accurate. Obviously, we'd all be multi-millionaires and retired if there were such a thing. So you have to always know that whatever you're using is not 100% perfect. But we are used by the pros, quoted in the media pretty much almost daily. Jim Cramer's a big fan of our work, and so is John Najarian, John Carter. I know there are a number of you from John Carter's Simpler Trading community, as well as John Molden's community, and Mark, or our chief market strategist, Dan Russo, is quoted in CNBC.com pretty much every week. We've had a number of articles written in Barron's, etc. So we have been around for a while and have been tested in real time to be found reliable enough that NASDAQ engaged us a number of years ago to create indices based on the power gauge rating. Index IQ, which is New York Life Insurance Company's investment arm, then licensed those indices and created ETFs out of them, which they have now been marketing for over a year to the New York Life community and their audience. We were invited to open the bell at NASDAQ back in April 30th of this year, which you can see here was pretty exciting. They had the Chaikin power gauge rating wrapped around the what do you call it? It goes around, and it goes that tower that you can see on Times Square that circles around So for like an hour and a half, you had the Chaikin power gauge rating and the ETF symbols and various comments about them circulating in Times Square. It was a pretty awesome event. But it's really about the users that we want to appeal to. Jim Cramer is one of those users, and he speaks very highly of Mark's work. He says, I want to explain why I love Mark Chaikin's stuff. It's simple, it's understandable, it's rational, it's not emotional, and I use it constantly, and I almost never want to go against it. So let's move on to what to buy. I want to just pause here for a minute and make sure you all understand the power gauge rating, because that is the centerpiece of our work, and it is the foundation of what I'm going to be showing you going forward. Gosh, I'm hitting the Q&A button, but I'm not seeing anything. Is there something I'm doing wrong?
I don't believe so. How about this, folks? If what Sandy's saying makes sense with the power gauge, please type a yes in the Q&A window.
I'm just not seeing those replies on my end, but maybe Josh, you can just tell me. Oh, there's a yes.
They're starting to roll in. All right, they're starting to roll in. For a second, I was worried about our QA window, but they're starting to roll in. There we go.
Okay, good. I guess it was just a delay.
Yes.
All right. Teresa and Elizabeth say yes, and I guess the others are queuing up there. Okay, great. Well, we'll move on here. Step 2, what to buy, a classic bull. We look for 4 basic components in a stock before we hit that buy button. And let's go through them on a number of charts. But first, this is really important to understand the concept of how a stock price moves. And this chart was created by Dr. Wyckoff about 95 years ago, showing the way a stock actually moves. And when I first started looking at it, I thought it was really confusing. But if you try to just kind of avoid looking at throwback, markup, correction, etc., like the words, and just look at the way it moves. It's a stock price zigzags across. It shoots up, it pulls back, it shoots up, it goes across, zigzags up, back again. Understanding that that is the way a price stock moves when it's on the upswing will really help you with timing. And you said timing was your number 1 concern. This can really, really help. And it's a pattern I heavily rely on, and it's actually one of our indicators. The overbought, oversold basically tracks this. So you can really see it very clearly when those dips are and when those peaks are. You want to buy the dips. You'll hear Mark and other Wall Street pros say buy the dips. That means this is the dip when it zigzags down for a minute. And they say sell the spikes. So when you're selling the stock, you want to wait for it to spike up like this. You don't want to sell it down here. You want to sell it up here. And again, wait for that dip. So when I say buy the pullbacks, it's the same thing. When you're looking to buy a stock today, you want to wait for this to pull back. And you can see from the stock chart, it inevitably will pull back. They may not be as pronounced as they haven't been in January as they normally are, but there still will be spikes and dips. It's inevitable. So let's put that into practice with a classic bull, Regeneron. We start looking at this chart on the bottom, which is the power gauge rating, this ribbon along the bottom, which is showing green pretty much since June, says that the power gauge rating for Regeneron has been bullish since June and still is. So that's good. Check mark number 1 is checked off the list. We also want that stock to be, outperforming the S&P 500, because if you're not going to outperform or look for stocks that outperform, you might as well just go with the SPY and get an average of 10% return a year, which isn't bad. I mean, really, you can do a lot worse than 10% a year. But if you're looking for the bigger gains, the 15%, the 20%, the 25, 30% gains a year, then this is the type of pattern you're going to want to look for. And one of those components is relative, the stock's outperforming relative to the SPY. And you can see it's the second one here from the bottom, this green kind of heat map here. Green means outperforming. It's good. I'm going to come back to overbought, oversold. That's what I said was tracking that Wyckoff chart. And let's go up here to money flow. Money flow was what Mark created back in 1988 when he worked on Wall Street. And what it does is it measures institutional money coming in and out of a stock. Since he's created it in 1988, what's that, 30 years ago, it's really now on every stock charting package and software system worldwide. It's on Bloomberg. It's on stockcharts.com. It's really, you won't find a stock chart without Chaikin money flow. Sometimes it's abbreviated CMF. Sometimes it's called Chaikin oscillator. But it all measures institutional money coming in and out of a stock. And why is that important? It's important because if there's money coming into a stock, like you can see here in this section, June through basically September, that means institutions are buying. You want to follow the smart money. If institutions are buying, they're going to push that price up. Remember what I said earlier, it's supply and demand. If there's a lot of people piling into a stock and buying it, that price is going to go up because there's less shares available for those that are trying to buy it. And you can see, all things being equal, power gauge being green, relative strength green back here in July. And look what happens when the money flow kicks in, though. I mean, you really go from, you know, kind of a sideways move here in the 280s or so, 300s, you know, all the way up here, you know, all the way up here to a high of like 422 or so, and back to a nice high today. So that's the kind of pattern you want to look at. You can see money now is coming out, this red. October, November, as we all know, and December were pretty brutal months. This has very little money coming out relative to some stocks that I'll show you later that have a lot more red going on than this. So this is really mild for October. October was that big down month, as you recall. And you can see it formed that same type of pattern that the SPY chart did in the beginning, but not as pronounced. And look what we got here. These green triangles are buy-sell signals. The red ones over here, as you see on the far left, are sells. The green is buy. We have 6 pairs that trigger when certain criteria is met. This one happens to be a relative strength buy. It triggered on Christmas Eve when it hit that low of 340. So if you were watching this stock, you would have gotten an alert saying, hey, there's a buy signal on Regeneron. You might want to think about buying it now. It's at 340. That would have been a really good move, right? Because it's now at 422. Hit a 52-week high today at 422. And you can see the stock has gone pretty much straight up. But, you know, look, here's a pullback as early as, that looks to be about 7 or 8 days ago. Back below 400, it looks like it was about 390 pullback. It's now 422. So there are pullbacks. This is what you've got to wait for to buy, though. And now I'll explain overbought, oversold, because it correlates with those pullbacks. You can see here Christmas Eve correlates with this overbought, oversold dipping way down. When it goes below that 30 register here, that's when you want to buy it. So this buy signal is saying, hey, the relative strength is really strong on this stock. It didn't know necessarily that it was oversold, which is what's considered the term on that dip below 30. Remember I said you want to buy on the dips? But it was correlating, which was pretty cool. Money was coming out of everything. There really wasn't a stock. I think there were 2 stocks in December that didn't have red money flow. I mean, it was just a red month for money flow. So you have to kind of discount money flow just because it was so pervasive. There were all those algorithms triggering off as prices went lower. It triggered more selling, you know, from these algorithms, what are these computerized trading programs that sell when certain criteria or prices are met. It just kind of went into automation and just sold, and the prices kept going down, down, down. So you want to look for this type of pattern and ideally wait for a buy signal. And that can give you often a really good time to enter a price if it ties in with this overbought, oversold. So I know that's a lot of data to kind of factor into your thinking right now. So let's look at a few more examples. And I think the more your eyes you get used to looking at these charts, the more it'll become obvious to you. So here's another classic bull, Cadence Design. This, though, hasn't had that strong persistency of power gauge rating, but since mid-January, it's gone green. Relative strength is green, that's good, and there is money coming into it. A little bit of more money came out of this stock in October, but you can see it's pretty much not bad in December, which was a horrible month for money flow, but that not so bad in Cadence. You can also see the same thing, that relative strength buy on, this happened to be on 12/26, the day after Christmas. And it too corresponded with an oversold position. It was dipping down. You could have bought this stock on the dip at, what does it look like, about 42, I think. I think that's at 42. The stock is now at 47. This also hit a 52-week high today at 48. Mark recommended this stock to our members January 20th in his weekly commentary, which he sends a Sunday night report to our members, always with a stock recommendation, a buy or sell in it. On the 20th of January, he recommended Cadence Design. And this stock has had a really nice run since that December 26 buy signal, right? All right, so how do I find these stocks? Let's move on to step 3. Okay, it's great to look at these stocks, but how do you find them? Well, we have what we call a screener in the workstation, and what this does is it allows you to put any number of factors, basically, qualifying factors, into the screen that you see here, which is basically one long screen. I just couldn't fit it on the slide. But you could play around with this and put any number of criteria in here and then run the screen. It'll filter out stocks that don't meet this criteria. So you're left with only the stocks that do meet the criteria you're screening for. In this particular screen, let's go through how I identified the 4 stocks I ended up with when I did this screener, and why I chose these criteria. And these are a little different from what I have typically done in a raging bull market, because we have been a lot more volatile. I put in slightly different requirements, but you can make note of these and run these screens yourself, and then play with them. If there's certain fields that you feel are more or less important, you could just play with trying those out. So first I go, just show me the stocks that are in the SP 500, and I got 492. I only want those that have a bullish power gauge rating, which instantly filters out all but 82. And then remember when I was showing you step 1, the Chaikin power gauge rating, and I showed you the expert component. I said this component is really our secret sauce. It's very predictive, in my opinion, to looking at a stock's potential to outperform. I want that expert component to be bullish or very bullish. I'm down to 53. And within that component, I want the estimate trend, what the analysts' trend is to be bullish as well. We are in earnings season. Analyst opinions and expectations have a huge influence over whether a stock is going to beat or miss earnings and spike or drop. So I want the analyst to be looking favorably on the stocks that I'm looking to buy for the long term. And I go down here to relative strength, and I want it to be relative, outperforming the SPY for approximately 6 months. I mean, that gives me confidence that the stock's on the move. It's on the momentum of going up. And then I put in a beta just because we have been so volatile. I put in this beta of over 1 and under 2, which filters out stocks that aren't very volatile. And you might say, well, gee, why would you want to do that? Well, the stocks that aren't very volatile are kind of the sure and steady ones, like the utilities. They don't tend to have the price moves that say a Boeing or a Centene or a Crocs have. They're more slow and steady. I'm looking for the bigger move stocks. So I want them to be volatile. I want them to be spiking on earnings or I don't want them to be dipping. I wouldn't be looking at that if they were, but I want them to be a little more volatile. So I ran this screen, this exact same screen, back in January 16th, 2 weeks ago, for a presentation I did. Excuse me. And you can see here I got 4 stocks, 2 of which were the ones we just looked at as Classic Bulls, Regeneron, and Cadence. These are the prices back on 2 weeks ago. I ran the screen again. I got the exact same 4 stocks 2 weeks later today when I ran it. And you can see they're all up in those 2 weeks, anywhere from 2% to 5.2%. And the SPY during that same 2-week period was up 3%. So you can see these, with the exception of Salesforce, the other 3 were far outperforming the SPY. And that gives me confidence that these 4 stocks are still really great buy candidates to buy on pullbacks. Let's look at those others too, which is Salesforce.com, and we'll also look at Oracle. So here's Salesforce.com. Now, another interesting thing to note is stocks that made an all-time high in September, as these 4 did, and you can see in September here the price spiked up to a high of, it looks like, 160. But those stocks that made highs in September, which still have good potential as these do, they're really the best stocks to buy on pullbacks because they're more likely to rebound faster and outperform to the upside. And you can see this is really what's happened with these all having these huge, moves up. This was true with Regeneron and Cadence, and it's true with the other 2, Salesforce and Oracle, as well. So just another kind of proof point that the way I'm screening really does find stocks with the strongest potential. Okay, so look at this stock now. Power gauge rating is strong. It's outperforming the SPY, and it does have strong money flow coming in. And the money flow wasn't horrible in October, November. Certainly December was pretty mild. And you also got a buy signal in December on Salesforce. Now, this stock has been recommended by Mark, gosh, for this last 6 months. I mean, he loves this stock, and I believe, yeah, Jim Cramer loves this stock too. They both were talking about this back in November on their joint presentation when it was 142. So it got a relative strength buy signal as well the day after Christmas. At 130, it's now 151. That would have been a great entry point. But I mean, all this goes to show is that it's great to get these ideas from Mark and Jim Cramer, but you can get them yourselves. I mean, I just did with the screener. I just ran the screener, and I'm getting, some of the same ideas that Mark and Jim are talking about. So, I mean, it all goes to show you don't have to be an expert. You don't have to be a market guru to find winning stocks. You can do this yourself if you've got the right tools and the right methodology. And this is what I'm doing. There's no reason why you can't do the same thing. So let's look at that 4 stock, Oracle. Again, look at the all-time high the stock made up in September, almost all-time. It looks like it hit that high in March. But it peaked nicely in September. It's now all green again. Power gauge rating, relative strength, and money flow is all green again. So, again, this follows that same positive pattern. This has been on that screener from 2 weeks ago, as well as the one that I just ran today, this morning. So that's how I find winning stocks. Okay, so how do you know when to buy them, though? How do you know when to get in? And more importantly, when to get out? Well, I'm going to go to that in 1 second. First, let me read you this testimony. We get a lot of testimonials from our members. This is from Sandra, practically exactly a year ago. Her 401k plan was up 47% in 2017. That's the year the SPY was up 20%. She more than doubled it. She couldn't have accomplished that without the help of the entire Chaikin team. Sandy's encouraging words, "You can do this, and here is how," was so empowering. "My husband has confidence in my judgment. Thank you, Chaikin, and I feel empowered. Life is good." So you can do this. As I say, you don't have to be a market guru or an expert like Jim Cramer or Mark Chaikin to be able to pick winning stocks. You can do this yourself. And Sandra L is gives us the perfect testimonial to that. She now has confidence, as does her husband, and she feels empowered. You can't feel empowered if you're not confident, and you can't get these outsized returns on your investments if you don't have confidence. So, it all kind of bundles together. So let's look at timing decisions. This is where most of you said this was your number one challenge. Buy signals. I've been pointing out the buy signals, particularly the relative strength buy. There's 6 pairs that have criteria that are met that when they trigger the buy and when they trigger the sell. Those are really great guidelines. They don't mean, oh my God, you got to do this right now, but they're a great alert to say, hey, something's lined up really well on this stock or not. Now is a good time to look at buying that stock, or on the reverse side, selling it. The oversold indicator, which I was pointing out, that measures those zigzags up and down, the peaks and the valleys. Those are really helpful. Well, how do you know when those signals, though, have triggered? Well, we make it pretty easy by having what we call an alerts view. It's an overlay you can do with a click of your mouse on the platform on any list that you have in your workstation. You can do it on the SPY, for instance. You can do it on the Dow 30. You can overlay that alerts view, as I did here, on your watch list. These are stocks that I'm watching. I basically keep two lists. One called My Stocks, that's the 10 or 15 stocks that I own. And one is what I call the watch list, the ones that I'm monitoring. So I want to know when a signal is triggered on stocks that I'm monitoring, because that might be a call to action. Hey, you better, this is a good time to buy this. It also tells me other alerts, as you can see down at the bottom, if power gauge rating has turned or if an analyst estimate has changed. And remember I said that analyst estimates can be very predictive on a stock can react very strongly to an analyst's rating. When, say, a company, an analyst downgrades a stock, that you can often see that stock fall 5 to 10% that day. They're that influential. That's the word I'm looking for. They're that influential on the market. So I want to know when those analysts are changing, as they've done here on NVIDIA. You can just see on the right, on the bearish alerts, there was an estimate revision downward yesterday on NVIDIA. If I'm looking at buying that stock, that's good to know. The bullish ones you see are on the left. You can see the various buy signals, and you can also see earning surprises and earning disappointments. We also send you, if you opt into this, an email every morning before the open of the alerts in your stock list. This is the My Stocks list. These are stocks that I own. And you can also opt in to get alerts in the SP 500, which is interesting too. Kind of gives you insight into the market, particularly in terms of categories, strong industry groups and sectors, and weak. But you can see here, it triggered today, Boeing triggered a momentum breakout buy based on its strong earnings report yesterday. And you can see that they posted yesterday an earnings surprise, and I said the stock was up 10%. That's how reactive stocks can be to earnings reports. Another one of our members, Alex, says, I can't tell you how happy and grateful I am to have found Chaikin. I found you through Jim Cramer, and that is a day that changed my investment life. I see we're at the hour right now, so we are going to go a little bit over because I'm going to take you through some examples of when to sell. So if you can stay with me, that's great. If you can't, this is being recorded and will be sent to you tomorrow midday. So if it's okay with you, I'll just keep going. Just type OK in your Q&A if you want me to keep chugging along, and I'll do that. Okay, when to sell? I think this is the hardest thing for most people. You sell whether there's two scenarios that would cause you to sell. Either you want to take a profit, or you're sensing that the stock is breaking down. And there's two separate ways of taking action on this. So let's break it down. And selling to take a profit. This is when the price hits that upper volatility band. I'm going to show you some examples and point this out. It's overbought. That's the spike up, as opposed to the dip down on that overbought, oversold indicator, or the price spikes after a strong earnings report, like Boeing did yesterday when it spiked up 10%, for instance. Okay, those are scenarios under which you can take profits, or which I take profits, and they've worked well for me. So let's look at a few of them. The first one is WellCare. This is a stock that I bought at this yellow hour, a buy signal in July, late July, oversold buy. It told me that means it's dipping down. You can see here, correlates here to the dip on the overbought, oversold. I bought it at 252. I knew they were reporting earnings a few weeks later, or actually a week later, which is, I knew because of this EPS right here, and it tells you up here when a stock is reporting. Really helpful. And I knew from past that this stock had beat earnings estimates and usually spiked up. So I was betting on that, and that's what it did. So it did. It kept bumping up above its upper volatility band, pulled back a little bit, and then bumped up again in late September. And it bumped up to a 52-week high, 319. Now, one of my rules is when it bumps up against this upper band, that's a good time to take your profit and get out. And I'm a sailor, and I think of these volatility bands as channel. When you're sailing, you need to stay in the channel, because if you go outside the channel, you could run aground or hit a submerged log or a submerged car or whatever. In other words, you could get in trouble. Stocks that go above their upper volatility bands tend not to stay there very long. And you can see over the past history, they kind of just, was going up against that band. And you can also see that it was evening out. So my thought was, well, gee, this is really great. It's up on that upper band. It's at an all-time high. I'm going to take my money and say thank you very much and make my 27% profit in 6 weeks. What also gave me confidence is that, look at money flow. In September, it started to go red. Institutions were selling. And remember what I said earlier, you want to follow the money. So if institutions are selling, that could be a sign that there's trouble ahead and the prices will be coming down. So another reason that just confirmed my decision to sell, and I was right in doing so. The stock has now gone down to 275. It's rallied off this low of 220 back here in December, and that at that Christmas Eve, selling massacre. But it's still 14% below where I sold it. So I'm happily out of this stock and have the money invested in another stock that had more potential and didn't go through this significant drop, as you can see here with WellCare. Okay, so WellCare is reporting next week, February 5th. It's on Tuesday. What I did for you here, this is the same chart, but what I did was I dropped down from the power gauge rating, which is overall very bullish. I dropped down the expert component. So you can see right here, the expert component is bullish. This is the component that I screened for. And when I screened for classic bulls, I want this expert component, this whole roll up here, to be bullish, as WellCare is, or very bullish, or all the way over to the right. I want estimate trend to be at least bullish. It's very bullish. And you can see from the other factors here, analyst ratings, very strong. Insiders, they're not really buying it. I like insiders to be buying it because that means they have confidence the stock's going to go up. The shorts, they're kind of shorting this stock, which means they think the stock might be going down. So what to do? I'm going to ask Josh to put up another poll question here. You've now been looking at these charts for the last hour. What do you think? Would you buy this stock before they report on Tuesday? And I gave you a yes, no, and kind of a hedge of a maybe. So just look at the pattern here. Although I guess, Josh, is there a way to move that poll so they can still see the expert component breakdown?
You know, that's a great question. On my side, as a presenter associate, I can move it around. I can grab the top of it and move it. I don't
Okay.
embed
Yeah,
it
maybe
in
just
theirs.
move it so they can see that expert component.
We have some results rolling in. We'll give it a few more seconds here.
Well, just to recap, the expert component, I believe, was bullish. The expert trend was very bullish. And they report on Tuesday.
All right, let's share this with everybody. No fence sitters.
Oh, no maybes. I'll be darned. Okay, 32% of you said yes. 68% said no. And no maybes. Okay, interesting. So the 68% of you said no. I'm just curious, was it because of the overbought, oversold is still peaking up here? It's not below this 30, so it's not giving you that dip. Was that why you said no? Maybe you can just put in your Q&A box, those of you who answered no, just if that was why you're not wanting to buy this stock. Timing, it wasn't the right time.
Comment of too many shorts.
I wouldn't buy a stock right before earnings, says Michael. Elizabeth, because of the short interest. Okay, good answer. I don't see any others coming in right now.
One other I knocked out that also agreed with the short interest.
Okay. Okay, fair enough. Yeah, I wouldn't buy it right now because of the timing. I would wait for that pullback. But if this stock is still lining up and the expert trend and the estimate trend are still strong, come Monday, I would consider buying it if it was having a pullback. That's my thinking. Let's go to another example of when to sell. This is a stock. The yellow arrow shows you at the money flow buy signal back here in August, where I bought the stock August 23rd at 196, and I sold it 3 months later when it hit that upper band. Again, it hit that upper volatility band, And you can also see money flow just started to turn negative. So I said, thanks very much. I see it's at the upper band. It's also overbought. It was dipping, peaking up, giving me that nice spike. And money flow turned negative literally the day after I sold it. So that just confirmed that I made the right decision. In fact, I think I did that. I did indeed, because I sold it at 208 and the stock is now 187. So again, these rules can be very reliable. I mean, you still have to look at other factors, taking those into account, i.e., the whole picture here, but they really can be helpful with your timing decisions. Now, this stock just reported, Amgen just reported on the 29th. I think that was just Tuesday of this week, 2 days ago. And they did report strong earnings, as you can see here by the green, and the green EPS way over here next to the date, but guidance was disappointing. And that's the frustrating thing. If they're looking at their outlook, at their guidance is what it's called, not as strong as the analysts were expecting, that can just tank the stock, which is exactly what it did. So they beat on earnings and revenue, but they guided lower, and that was the killer. So all the things to be looking out for at earnings season. Okay, let's go into breaking down. This is when the power gauge turns neutral and another indicator, like relative strength, turns negative. And I say caution now because of these highly volatile and dramatic months of December and now January in the opposite direction. I mean, we were up 15% from December 24th. I mean, that's a huge swing in a very short period of time. The power gauges, the money flows, I mean, they're not perfectly aligned. So that's why I say use caution and kind of look at everything collectively. Certainly if you get a sell signal, that's a really good time to say, hey, I really better sell this stock. Or if it drops below that orange line, which is the 200-day moving average, or those lower volatility bands, as I call them, the channel markers. Channel markers. Okay, so let's look at this is still the best example I have of a breakdown. I bought this back in April here on a money flow buy at 32. It spiked all the way up. It spiked like 18% this one day up to this upper volatility band. There was no news, and we do carry news down on the bottom of each stock. I didn't copy it on this slide, but we do carry news articles. But there was no news on this stock as to what was causing that 18%. But it doesn't matter if a stock jumps up 18% in one day. It's time to say, hey, thanks very much. I'm going to take my profit and be out of this. It was an all-time high also, and again the money flow is negative. Look at this red money flow. So I said, okay, great, I'm out of here. I sold the stock. The next day I see that they had signed an agreement, a contract with Puerto Rico to complete the rest of their electrical transportation and distribution system that had been knocked out from Hurricane Maria, and reconstruct the power grid. I mean, that's a huge, big order, right, for the whole country. So no wonder it spiked up 18%. You can see it went up a little bit further about a month later. But then look what happened. It started to break down. I mean, I can't remember what was the reason it dropped here. It looks like another 20% drop in July. And then you can see what's happened. It's just dropped down. And look at the huge money coming out of here in December. Remember when we looked at those classic bulls, they didn't have that much red money flow in December. This has a lot of money flow in December. So this was a stock that I was glad to be out of. I never looked back. It's now at 23, so it's like 40% below where I sold it at 38. You don't want to be holding this onto a stock like this, waiting for it to come back. When you could have been out knowing what you know from this chart at 38, right? Okay. One more testimonial here from Norm. Through following your excellent system, my portfolio now stands in excess of $1 million. Before Chaikin, I would make money and then lose it. Consistent earnings were just not a reality. Chaikin has changed all that. I can't thank you enough for your tremendous service and excellent methodologies. And again, I stress methodologies and consistent earnings, because in order to have consistent earnings, you really have to have a methodology that you can depend on, which you're following. And for me, it's this 5-step methodology that I'm sharing with you today, and I hope you'll come to the same conclusion. These are powerful methodologies. Quickly on to the last step is avoiding the pitfalls. You've got a classic bear, which is basically the reverse of the classic bull. And we want to, again, follow Warren Buffett. Avoid risk whenever you can. I mean, that sounds obvious, but risk is inevitable. You cannot avoid it entirely. It's inevitable. And if it makes you so nervous to lose any money whatsoever, it's probably not a good idea to be investing in the stock market, because you will incur losses. It's just no way around it. The point is, you want to make them minimal. You don't want them to get the best of you. And you can do that by identifying when a stock is breaking down. And it will follow this pattern. Again, this is the reverse of the Wyckoff bullish distribution. This is when a stock is breaking down. Again, it does a zigzag maneuver. You know, you want to sell it when it's spiking up here on these zigzags. You don't want to sell it when it's dipping down here. You want to wait for it to come up, back up a little bit. This is called that overbought condition. This is the peak that's measured on that overbought, oversold. And again, you want to sell it when it's at these peaks, not in the valleys. So let's look at NVIDIA. NVIDIA, the power gauge went bearish. You can see in October, at 290. It's now 142. That's down over 50% from when the power gauge went bearish. The power gauge is powerful, guys. I mean, you really want to follow the power gauge. And members who were following NVIDIA, if they owned NVIDIA and they had Chaikin Analytics, they would have known back in October at 280 or 290 to get out of the stock before it tanked. And you can see shortly after, relative strength went red and money flow went red. So that the stock, you know, this was just an alert. Hey, the power gauge is going from green to neutral to red, and then relative strength kicked in negative and money flow kicked in negative. You know, you can't go against the facts. This is inevitable that this stock was breaking down and you wanted to get out of it. And you can see how quickly the price dropped in October. It went from like 290 down to what it was, about 180. That's up in 1 month. I mean, that's a big loss. You don't want to ride that loss down. Again, you got these sell signals in January. If you weren't already out, this would have helped you get out. And they report in 2 weeks, February 14th. And I again am showing you the breakdown of the expert component, which is very bearish. Estimate trend, very bearish. The shorts are neutral. The insiders bearish. They're not buying. The analyst rating trend is bearish. And the strength of this relative to the industry is neutral. This is, we measure down here relative to the SPY. In the expert component, this industry relative strength is relative to its industry group. It's neutral. Do you think, okay, there's one last little quiz for you guys. Thank you for staying on. But one last quiz question. Will they beat or miss? What do you think? By the way, Josh teaches our members how to trade options using the Chaikin Analytics platform. We have an overlay called Options Play, which gives you the 3 highest risk reward scenarios. And twice a week, he gives our members lessons on how to use them. We also have our chief market strategist, Dan Russo, who puts out specific ideas, as does Josh, on these presentations. So you can use these bearish examples very profitably by betting on the downside through options trades. All right, Josh, what do we have here? We'll miss 75%. Yay. Okay. That is great. Thank you. I would agree with that. I mean, all of the data is going against you. Bearish power gauge rating, relative strength, underperforming. Money's coming in, but look at how much went out. And look at the recent sell signal saying get out of this stock. And this whole estimate trend. Josh, if you can close that poll, we can just revisit this expert trend. Thanks. Expert trend of being bearish to very bearish. So everything's pointing to a downward move. I'll follow this. I'll give a webinar every 2 weeks. We'll see what this is doing in 2 weeks because it will have reported on February 14th. Okay, one last example, Qualcomm. This again is a classic bear. You can see bearish power gauge, relative strength underperforming since November, and look at all the money coming out in October, December, and still bleeding out of the stock. You can see the power gauge in October went negative at, what is that, about 70 something, 71. The stock is now at 49. So our members would have known back here in September, or October, excuse me, that they better get out of this stock. And also you can see that the money flow started turning negative about the same time. And then it triggered some sell signals here, November, again in December, both at 57. And again, money flow was negative that whole time. They just reported yesterday. They actually beat their earnings estimate, but they missed on revenue. And when I broke down the power gauge rating to look at the expert component and the estimate trend, just like NVIDIA, were both very bearish. So our work was pointing to a negative reaction. And you can see the stock is not down that much, actually. It's only down at 1.5%. So it's not down that much. Okay, I told you that many of our members are making profits trading options. One of our members here in the 5 business days that have been using Chaikin have paid for the subscription over 10-fold. These initial results are nothing short of astounding. Please extend my thanks to the entire Chaikin team. So, again, Josh can teach you how to use Chaikin Analytics to trade options and make profits on the downside. Okay, my promise in the beginning was that you would discover how to find winning stocks in 5 simple steps. And if you'll just open up that Q&A window again one last time and just put a yes if you feel that I delivered. Did you discover? Was this helpful? Do you see yourself using this? Do you see how this could make you some money? I mean, are these powerful tools that you feel you can rely on? Okay, I see some yeses coming in. Michael, John, anonymous, that's okay. All right, thank you. Yeah, that's great. Thank you for the feedback. I work really hard to try to educate and teach, and I hope that it comes across, because I'm very sincere when I want to say that I want to make you confident versus fearful investors so that you can enjoy your profits and take some great trips like Mark and I have, mostly to Italy. All right, so what I showed you all were examples from the Chaikin Analytics desktop platform. We normally sell the system for $2,195 a year, but we're taking $300 off as a webinar special. But I am going to make that offer a little bit sweeter. If you can just bear with me for a few more slides. Some bonuses that are thrown into the platform are the screener, which we talked about, and the options play, which I just alluded to, but Josh will teach you more. And those are like the 3 scenarios that it points out. So you don't have to do all that massive calculations. You basically take their recommendations and start from there. And then I think this is really, really our secret sauce as a subscription service, in that we give you small group tutorials. So as early as tomorrow, when you join tonight, you'll be put into a small group tutorial tomorrow to help you set up and use all of the features. So Josh or one of his team members will walk you through how to create your list, how to overlay that alerts view so you know what buy sell signals are triggered, how to break down the power gauge rating so you can see the various components and factors that make roll up into that power gauge rating, etc. They'll show you all of how to use it. It's unlimited. It's ongoing. And if you need individual attention on how to use it for your coaching, your trading style, you can set up a one-on-one coaching call free with one of our customer success team members. And I think that's amazing. And this is unlimited. I mean, our success as a company depends on your success. So we invest heavily in your success. Jim, one last testimony from Jim Kramer. If you don't use Mark Chaikin's work and Chaikin Analytics before you pull the trigger, well, you're going against 32 years of my work. Jim's been following Mark all those years, going back to when he created the Chaikin Money Flow, and he's a big believer of Chaikin Money Flow, as you can see on his nightly news shows. He often refers to it on his charts. All right, so I told you that we'd make the offer a little bit better. So we're taking an extra $100 off for $17.95 when you subscribe and become a member by midnight tonight. And get that extra $100 off for a total savings of $400. So I hope, as many of you said, that you did find this helpful, and that I did deliver on my promise to you to show you 5 simple steps to find winning stocks, and that you'll join Chaikin Analytics and see how you can find those yourselves. You can do this. As I say, if I can do this, you can do this. So Josh, I'm going to turn this back to you to close out the webinar, and I thank you all for participating and staying on.
Thank you, Sandy, so much for your time tonight. Thank you, everybody, for attending tonight. To take advantage of Sandy's offer, I put the link in the chat window, so you can click on the link. It'll take you right there. The discount will automatically be applied, or you can call us. My colleagues are available to answer any questions you have. That number is 877-697-6783. Again, you sign up tonight, you'll get a call from one of my colleagues in the client success team tomorrow. We can get you on one of those small group tutorials. If you can't make it, we archive everything we do, and we'll show you where the archives are. We'll send you out a link so that you can get up and running, even if you're not available specifically at the time we're live tomorrow. We white glove everybody here at Chaikin Analytics, and I'm proud to be a part of that client success team. So again, call us 877-697-6783 or www.chaikinanalytics.com/Sandy. The link is in the chat window now, and it'll automatically apply the discount for you. Thank you all, and have a great night.